Good morning, all my fellow Americans. It is Friday, November 9th, and we still don't know the makeup of the Senate and a couple of governor races. And you know what? I don't think it matters that much. So let's start out with talking about the election because that is the narrative of the week. I don't think it mattered very much. There, I said it. Don't think it matters very much. I think that President Trump got a pretty good victory in the Senate, but I think we all knew that was coming because of the seats that were open. Republicans will have at least 51 seats, and it looks like 52, maybe 53. We should know in the next several days. Apparently, a lot of people mailed in their votes, and that is pretty amazing to me that we had such a big turnout. We had 60% of the people voted, which is really nice that we got that kind of participation. And I think that that bodes well for the future. What does it mean that the Democrats took the House of Representatives? I think that it means that things are going to stay the same. You know, the Republicans weren't going to do much more on the economy. They already got their stimulus. And I think that if there was going to be a middle class tax cut, probably wouldn't have happened until late in 2019 at the earliest to kick off the presidential campaign, maybe. But I think 2019 is shaping up to be a year of not much happening other than Maxine Waters probably issuing a lot of subpoenas. And frankly, I think that's understandable. Will it cause turbulence in the markets? Who knows? I think that everybody is aware that there is some issues with the emoluments clause of the Constitution and the fact that the Trump organization is making some money off of the government renting Trump spaces. I don't know legally what that means. Probably means that by the time they figure out what it legally means, it would be many years down the road. So I'd expect an answer on what exactly the rules are on that sometime in the 2020s. I don't think it matters much right now. Now, that doesn't mean that people won't think that the president is a crook. I lean in that direction. But as far as how it works for the economy and for our investments, don't think it matters very much. The chart that I have up right now, I think matters a lot, though. So we're going to talk about interest rates and the price to earnings ratios, as well as the CAPE ratio, which is the adjusted over a longer period of time. And we're going to talk about some of the weaknesses of this ratio and some of the strengths. But I think just by looking at the chart, you can pick out a couple of things that are pretty important. So why don't we finish up with the politics real quick? There's probably going to be a little dance between the president and the Democrats in Congress, and that dance could include something on immigration. I think the Democrats, in order to save the Dreamers, will have to give in on the wall, at least on part of it. If they don't, then I don't know what they're really doing with that issue. They could have addressed that issue 8 years ago. They didn't when they had both the Congress and the presidency. And now it's a political football. So I blame both parties for what's going on with immigration. And ultimately, I think the rationale should be to say, well, we'll give you some money for the wall and more border security, but we need this and this on the Dreamers and on immigration procedure. They should be able to come to an agreement on that. We'll see if they do. Does it really affect our investments? A little bit. One of the reasons that the employment rate is drifting upward is because we have really hugely stemmed the tide of immigration. So we have a very low unemployment rate, and with the exception of millennial men, every group out there is basically at full employment. The only group that's not at full employment is millennial men. There's something like 20 or 25% of them aren't working, and it has nothing to do with disability. It has to do with, I'll be real frank about this, I think in most cases it's motivation in a lot of cases, but I think it's also ingrained over many, many years, that they just kept becoming further and further behind as they grew up. Lack of education, staying a kid too long. And that group, I don't know if they're going to drift back into the economy in any rapid pace. I think that let's get into reality here. As these guys get married or in serious relationships, their spouse is going to push them a little, or their girlfriend's going to push them a little. And at some point, they need to go to tech school. They need to get into an apprentice program. They need to start out at McDonald's. And you know what? I know guys that are managers of McDonald's, and they're rich now. So, Walmart's too. I mean, there is no shortage of work out there at this moment in time. And between setting the table, which is what President Obama and the Federal Reserve did from 2009 to 2016, 17, whatever. And then President Trump basically lighting the candles on the table. He really, really did encourage animal spirits. So the deregulation has been actually pretty good, with one exception. And the exception that we as investors have to watch out for is that the banks have been kind of given carte blanche again to ramp up their leverage. And I need to check in to see where that is. But I do know that the banks have ramped up leverage, the big banks. So that is a warning sign for us that we have to keep an eye on. Now, in the House of Representatives, there is oversight again to the banking system, that it leans more towards regulation. And there's not going to be any legislation, right, that goes through. So it's really going to come down to enforcing rules. And that really is the administration's job. They are the executive branch. They're supposed to be the rule enforcers. But the House of Representatives, House Banking and Finance Committee, I forget what it's called, Finance Committee maybe, they do have a role there. So, the banks really aren't supposed to be leveraged up as much as they are. How do you roll that back without causing a shock? I don't know. I don't know that you can avoid it. I think that what we are seeing, though, right now is that the stock market is shaking a little bit, and it's shaking for a couple of reasons. The first reason is, and we talked about this, with an article that I put out regarding a trade that we're doing, traders trade. And we know a few things about who's in the market right now. We know that retail investors have not been selling. We know that. Definitively, we know that. We can measure the cash flows. What we also know is that the institutions have really been doing nothing. They have to cash in some investments to pay income obligations, because many of the institutions out there are in fact retirement systems. So, you have that slow drift out of the stock market that we've talked about over and over again. And, I have articles out there that we talk about that. And, I get tired of rehashing it. So if you've heard this one too many times, let me walk you through it though. We do have a slow growth forever problem. And that is because of demographics, which is the massive thing that can't be changed, right? You can't change demographics, not in any quick way. And frankly, do we really want another baby boom anyway? So, you have to take a look at the fact that the aging of the population means that there's going to be pressures on the healthcare system, pressures on the retirement system, and just less spending in the economy in general. Now, the millennials in the United States, anyway, are offsetting the aging of the baby boomers. However, the millennials don't spend the same way that the boomers did. The boomers went out and bought toys, lots of toys. The millennials, when they feel like playing with a toy, they go and rent it. And that's actually good for certain types of businesses, right? Small businesses really can thrive on that. But it keeps money from going into more hard goods when you have a sharing style of economy, right? Where people rent something for a week or a weekend or a day or for 10 minutes to get from point A to point B rather than owning their own. And that is going to be, I think, persistent. I don't think it's going to change ever. And anybody who hasn't wrapped their head around that at this point had to really take a step back and think it through. I gave that interview a couple of weeks ago. Actually, I guess it was a couple months ago now. And I'm going to pop it up here because it's a pretty darn good piece. So Brian Bain, who I've known for a few years now, he runs Investor in the Family, which is a free service, did this interview with me. And we talked about things. And he has a really good set of notes in here, right? So I would take a listen to this because I talk about the boogeyman is not inflation. The boogeyman is deflation. And the deflation is happening because of the demographics and because of the huge debt loads and also technology. So one of the things that we're seeing with the changing of the economy is that supply chains are moving closer to their customers. Why is that, right? The shipping container industry, I think, is going to be under very heavy stress for quite a while because now, with the advent of more robots and smarter robots, you can build things here for about as cheap as you can in China and other places. Why? Because the robots are doing it. All you need is some engineers and a handful of people to make sure the robots are doing their job. Now, in Wisconsin, and maybe one of the reasons that Scott Walker lost is the governorship is because we have done a deal with Foxconn. So we are giving Foxconn $4.1 billion to build a factory here and employ 13,000 people. Originally, the split was going to be roughly 50-50 between assembly line people and knowledge workers, right? You know, engineers, R&D, things like that. Well, the split is now going to be 10% assembly line and 90% knowledge workers. That has a lot of people here really upset. However, frankly, I look at that as a good thing. I would rather have the higher paid, higher skilled people here supporting the economy than a bunch of people making $22 an hour. And while I know that a lot of folks out there think that $22, $25 an hour is good money, most of the people on this call probably don't, right? If you're investing money, that means you're probably making above the national average of 25, 26 bucks an hour. I would think that there's a lot of people on this call that make 3 figures per hour. I'm in that category, and I think that a lot of you are too. So when you take a look at what's good for the economy and what's good for investments, you have to look at it in tiers, right? Is everybody employed? Well, we already know that we're pretty much at full employment, and we're going to need a lot more healthcare workers in the future. So maybe those millennials go to nursing school, become RNs, LPNs, and an LPN. And they become caregivers. They have some skills and therapists and things like that. Who knows? But we don't really need a lot of manufacturing and assembly line jobs because technology is changing the whole industry. I know that people are upset with China for taking our jobs, but the reality is study after study has shown 80-90% of the jobs that left America were because of technology. And the jobs that come back to America are largely going to be because of technology. If robots And artificial intelligence can build something here and avoid the shipping costs for going over the ocean to get from China or the Far East to here, then you are going to see more supply chain here. So really, the ultimate success of the Trump administration, in my opinion, so far, is that you've gotten some of the supply chain to move over here in an accelerated fashion because of the tax code. But the reality is that companies are still going to produce overseas because you're going to want to produce in those local markets. Why? Eliminate the transportation cost. So think that through. This whole idea of pulling more jobs back here so that we can become a bigger exporter, it's not going to happen. It's just not. There's nothing the president or the government can do about that. They're tilting at windmills, right? So you need to just get that through your head, that the reality is that a little bit of supply chain will come back here because we have 330 million people, right? If you want a growing economy, we actually will have to grow the population. So you're gonna have to make that choice when you go to the voters booth. Do we want a better immigration policy that lets 3, 4, 5 million people a year in, or do we want a more constrictive policy? Maybe you think that's better, and just keeps the status quo. I'd like to see the economy grow. I drive all over the country. I know that there's plenty of small towns all over the country that, are dying because the people have left. I think maybe immigration policy should have something to do with, hey, don't move to a big city when you come here. Move to a small town or a little city. Become an entrepreneur. Granted, we need some knowledge workers because for whatever reason we can't keep up on engineers. But these big trends are things that we need to understand are the reality. So if you're hung up on the idea that, hey, we got to do this, this, and this, tax-wise or regulatory-wise, in order to bring supply chain over here, no, we don't. Technology is going to do it. The little tax holiday, we know was going 70%, give or take, into stock dividends and buybacks. So there's really not been any big upsurge in CapEx. If we want more CapEx here, maybe we should tie the tax cuts to CapEx. Maybe in order to get the low tax rates on the corporate level, it has to do with spending in America, right, on capital and on R&D and on wages versus just giving the money to the 10 or 20% of us that basically own everything in the country. We're going to do okay either way. Ultimately, we want to be in the things that are growing, regardless of which way the economy goes. We know that 5G is a big deal. We know that automation is a big deal. We know that artificial intelligence and the smart everything world, everything that's a part of it, is a big, big deal. That's where the bulk of our money is going to go for the next 10, 20 years. Alternative energy is coming. It's been stopping and starting, backing up, going forward for years. The momentum is to the upside for adoption. We have to find a way to translate that into making some money on it, right? I think that this couple of solar companies we're going to talk about are going to be a big deal. And there's others. So we need to really anticipate what is coming. We need to put these politics to the side, which I've talked about ideology before. The ideology that drives a lot of people, if you ignore it, right? If you can ignore that ideology, that drive, whichever direction you have, and just look at the reality of what's coming because of technology and because of demographics, right? And because of big debt loads at the government level, in which there's a solution for, and it's going to happen. And I'll talk about that in a second. Then you're going to beat everybody else. So that's the big picture. I know that you're going to get scared because there's going to be a narrative out there that's already out there. The federal deficit next year is going to be well over $1 trillion during an economic upturn. Normally, we only spend on stimulating the economy when we're in a downturn. Well, I would argue that we're in a perpetual downturn because of the slow growth forever demographic debt, and technology-driven deflationary forces. So I don't really have a problem with spending on development, things like infrastructure in particular, because that is the backbone for everything else in the economy. But we have to find a way of doing it without driving up the debts through the roof. Unfortunately, that barn door is open. And I think it's very likely that we see a significant debt issue in the next year or two or three, because the petrodollar and the dollar standing in the world, because of what's going on with tariffs, is getting damaged right now. The dollar is still strong, but it has shown weakness recently. And while I have been a bull on the dollar for a very long time, and we've talked about this in other webinars, I wrote an article way back on Market Watch, way back in 2012, why the dollar is going to be very strong for a very long time. I basically said the dollar would be the reserve currency for decades. And I still have that opinion, but I think in the short run, we're going to see some pressure on the dollar. Why? Because of the incredibly high deficit, and people aren't going to understand that there's a solution. And they're not going to like the solution, especially Austrian economists. They're not going to like it. But the reality is that eventually, and probably simultaneously, the big economies of the world with the big central banks, they're going to print money. And it's not going to be QE where they borrow it, right? They're not going to be issuing bonds to create money into the economy. We're going to get helicopter money at some point. 2021, 22, 23, 24, 25, 26. It's going to happen in the 2020s. And what they're going to do is they're going to print trillions of dollars. And rather than dumping it all into the economy at one time, they're going to trickle it in over a very long period. So when it happens, it's going to be 10, 15, 20, 25 trillion dollars. And it's going to bail out all the retirement system will have to be bailed out. We know that for a fact. They're already putting together the legislation. They've already built the skeleton for that. It's already been done in the last year. The Republicans did that. The Republicans know there's a bailout coming in the pension system and in the retirement system, Social Security and the pensions. It's coming. We know that Social Security starts running at deficit in the next year or two or three, and we know that technically on paper it's insolvent by 2040. So how do we handle that? You just fill the gap. We're just going to print money. And if they're smart, I know that with this much money, there's going to be a lot of ways to steal it. If they're smart, they will put requirements on how that money is handled, rather than just giving it to the banks and all the systems. They will figure out a way of saying, here's your bailout. This is how you must invest it. You must invest it in U.S. Treasuries. And then you can cash those in as you need them. So we'll see when that happens. I really don't think it's a matter of if. And there's not a way to balance the budget at this point. There just isn't. The interest on the national debt is growing. The obligations to the retired are growing. The growth of the economy doesn't have a way to grow beyond high enough. We're not going to get 4, 5, 6% growth. I did say in one of those Market Watch articles back in 2012 that at the last couple of years of this decade, I think I specified 2019, that we were going to start getting tape prints on GDP in that 4% range. We've gotten a couple. How long will that last? Well, I think we probably get some big GDP numbers in the middle of next year, but the beginning and end might be bad. Why? Tied to oil. So, I think that you just need to think about why the economy is the way it is. And then how can we benefit from the good things, and how can we sidestep the bad things? We did just sidestep a correction. I don't really know who's up on this so far. I'm not back to where I need to be because, frankly, this correction is going a little further than I thought it would go. Let's take a look at some important numbers. This is the Shiller Index, CAPE. Red line, interest rates, right? What do we see here? This is the bear market and interest rates for 20, 30, 40 years, right? Economy comes down. As interest rates come down, market did good. What people are looking at right now is they expect this red line to keep going up, and then that'll pull the stock market down. I'm telling you, we are at the neutral interest rate. We are. A 3% 10-year bond is the neutral interest rate now. Not 4, not 5, not 6. Historically, when you average out the red line, it actually comes out to a little under 6%. But where on this red line do you actually see the interest rate above 6%? Just here, when we had to kill inflation. Why would we ever need to raise interest rates above 6% again if we know that for the next 30 years or so, the major forces are deflationary? That's why I talked about that today. So I don't expect interest rates to even get to 5%. I hope they don't get to 4%. If Powell keeps pushing this interest rate up, the market will get crushed. Not only will the stock market get crushed, but the economy will get crushed. We need a loose monetary policy for a very long time. And all these little idiots, and I will call them idiots, all these little pretend wannabe Austrian economists who have never read the general theory or probably half of the stuff that's out there that they should read, understand that Austrian economics has been wrong since day one. It's never proven to be true. It doesn't incorporate the types of data and realities that Keynesianism does and the Chicago School tries to. So the reality is that if we raise interest rates, really, and that doesn't even have to get up to this point, doesn't even have to get to 5. If we get interest rates to around 4%, we're in big, big trouble because that'll mean that the yield curve has inverted. How do I know that? The long end of the curve is already telling us what the neutral rate is. The market is telling us that the neutral interest rate is about where it should be right now. So it's not as if Chairman Powell is a free market guy if he's fighting with the market, correct? So with the long end of the curve at about 3%, I forget where the tenths are right now. If Chair Powell raises the short-term rate to about 3, you'll now be tipping into an inverted yield curve. What do inverted yield curves have to do with the economy? Usually tips it over, right? Because it disincentivizes investment. So we need to keep these interest rates long for a downtime. President Trump's actually right about interest rates. Raising interest rates is a horrible idea. I've talked about it in articles. I'm going to really start ripping the Fed soon because they need to be ripped. And frankly, I want President Trump to politicize the Fed a little bit because the Fed has caused some problems in the past. As good as I think Ben Bernanke handled the crisis and Janet Yellen did things the right way, I think Powell, like Greenspan, let me use an economic term that I learned way long. I probably learned this phrase when I was 12. Fuck things up. The Fed can fuck things up the way Greenspan did. If they repeat this course of saying, well, interest rates on average were 5.75% over the last, 100 years or whatever. Where? This skews the average. 3 to 4% is the normal interest rate. And we should be at the low end of that range, not the high end. So, as investors, we really have to keep track of this. Because if you really keeps pushing these interest rates up, we're gonna get a donkey kick that you can't believe. It's going to be this bad again. Chairman Powell is the biggest deal here. He can crash all of this stuff just by pushing interest rates up another point or two. So, you want to get get something that's inflationary into your portfolios because they're going to create a collapse if they keep raising interest rates. But if they're smart and they keep this interest rate low, and the news this week was that they're starting to think about it, right? The New York Fed started to adjust some things. Then we'll start to get man-made inflation that will fight off the deflation. That's why, for the first time in a very long time, I started dipping my toe in silver and gold, right? Good song, by the way, Silver and Gold. U2, BB King. Pretty sure that's who did that song. So what we're going to talk about here for the next 10 minutes is how to sell puts on some of this stuff. One of the things that we do with both services is we sell a lot of puts to generate income. Why would I want to sell the put here rather than just owning core mining? Now, I do have a small position in core mining, but I like selling the puts. And right now I want to sell January puts pretty much across the board. Why would I want to sell January puts across the board? Because as we've talked about, the buybacks and Santa Claus rally and retirement money should keep the market from doing anything horrible in the short term. Come April, I'm not so sure. It'll depend on the Fed. Really, it'll depend on the Fed. What the government does at this point doesn't much matter. Frankly, I'd like to see them agree on an infrastructure bill that was well over $1 trillion. We're just seeing the end of the quote unquote shovel ready projects right now. You go across the country and all these road projects, bridge projects, all the stuff that they created the money for 8-9 years ago, those projects are finishing up right now. So by next year, those projects will be over with. And yet, our roads, and I'm a guy who drives them, and if there's anybody who owns a trucking company or does a lot of driving around the country, you know that there's bad highways all over the place, bad roads all over the place, especially in the northern half of the country, right? So, I haven't been to the southeast in a while, so I'm not really sure how the roads are. But I've been on some bad roads in the northern part of the country. So core mining, what do we want to do with this one? We want to sell the $5 put because we're willing to own it at $5. And we want to get more money, right, than the difference between the current price and $5. So $5 is our strike price. So we wouldn't sell a put for less than 33 cents, right? Because we could just buy the stock for $4.67. So what we're trying to do is create a cost basis that is 5 or 10 or 15% below this. So let's say 5% is another 23 cents. 430, we get a net cost of 430, 440. That means that we'd be looking for 60 or 70 cents in premium. So we look down here and we see that the bid is 55 cents, means that our net cost, if we got the stock put to us, would be 5 minus 55 cents, so 445. That's 22 cents lower than this. Not too bad. What I would do is I would enter my order, good till cancel, and I would say I'll sell a put, and you don't want to commit more than 2 to 4% of your money, but I would set my sell price at the ask. which is what I pretty much always do. I always ask for the ask. I don't ask for the bid. I want that extra dime, man. So I ask for the ask. Good till cancel. That would give me a 435 put, price if it's put to me. There you go. So 65 cents divided by the $5 that I have to hold in cash secured put, is a return of 13% over the next about 2 months, right? Maybe 2.5 months. Pretty darn good return. But even if you only get 55 cents, right? 11%, still pretty darn good. Now, let's say it's 3 months to make the math easy. That means that your annualized return on that cash that you're selling puts against is 44%. You know any banks paying 44%? No. This is why I love selling puts. All right, so let's go through some of the energy names. Antero is grossly underpriced right now. The traders are telling stories, and it's just so incredibly stupid that traders doing what traders do. So I frankly would be looking at the 1750 put, and I'd be going after the huge premium. So 215 divided by the $17.50 to hold it, 12% return, just a few months. Now, why would I do that? Because if I end up getting this stock, let's see here, 1750, that might not be enough, right? Minus 2.15. Oh yeah, I guess we're saving another 60 cents. Yeah. If I can get Antero, sorry, I was reading about Anadarko before we started, at 1535, I'm all over that. I want that. Right? Now, if I already have an Antero position, I don't really want it unless I get it for uber cheap, then maybe I go for the 80 cents on the 15, right? So 0.8 divided by 15, 5.33% for 3 months, still an annualized return of way over 20%. That's pretty good too. So the one that you pick to sell depends on your portfolio. Do you already have Antero? No. Sell the 17.5. If you already have Antero and you're stretching a little bit by selling a put against more, then use the 15 because it's not very likely to get put to you. All right. Centennial. Ooh, look at that. A green number. Now, by the way, I think oil's going to turn around possibly by this afternoon. All right. So just put that one in the archives and see if I get that one right too. If not by this afternoon, then I think next week. The Saudis are not going to let this oil price stand. They're just not. They can't afford it. And at this point, they're looking at all their alternatives right now. They already got the main thing they wanted. They wanted the sanctions on Iran. They know that the president can't withdraw those sanctions. So, Saudi Arabia really doesn't need us for much anymore, to be honest with you. They can start selling oil in yuan, which I think is going to happen. I think they're going to take they'll disguise what they're doing by using special drawing rights, but that actually diversifies the oil purchases out of dollars into like 5 other currencies, right? So we'll see what they're doing. They're already actually buying selling some oil in euro. So the end of the petrodollar is right around the corner. I've always said that I thought the petrodollar would be done by the end of this decade. I think it could be done by next summer, like by spring. So we're going to talk about that too. And that's another reason why the dollar will get weaker next year. Inflationary story. The Fed thinks they can fight that with interest rates. No, I mean, they just have to understand that we want inflationary forces to offset the deflationary. Otherwise, we go into another depression. And, I understand that people go, oh, we wouldn't run a household by running all that debt. It's too late. It's too late. Maintain standard of living. Avoid social incohesion. If you have to print $20 trillion and trickle it into the economy over 30 years through pension payments and social security payments and an infrastructure bill, then that's what you do. And then in 30 years, nobody remembers, and we screw something else up. There you go. So it goes. The more things change, the more they stay the same. That's why I don't think the election mattered that much. Other than I do like the check. I like the checks and balances there, right? I'm a big fan of gridlock. We only need parties to be in control for 2 years at a time, otherwise they go nuts. Centennial Development, pretty good CEO there, old EOG guy, Mr. Pappas, and this is a pretty clean company as far as finances go. I mean, because they started from scratch, and they have deployed their capital very well. They're very tied into the Permian. This is one of those companies that could really skyrocket. It is one of the few oil companies out there that I think could do great over the next year or two as the dollar weakens, as the Permian comes back online next summer, right? And I say come back online, the Permian Basin, which is like I put up a chart a while back, 70-80% of all new oil production in the United States. It might be higher than that. Because of a lack of pipelines, not really a lack of pipelines, but just their pipelines were full, and the new ones don't come on until starting next summer and through the end of next year. There is a drilling break, right? They've maxed out their drilling. They've driven our oil production up to 11.6 or 11.4 million barrels a day. It's going to stall out there for 2 or 3 quarters. One of the reasons why the price of oil is going to keep going up, right? It's going to reverse here soon. And the Permian plays, the clean sheet ones, those are the best companies to own. So takeaway won't be an issue starting next year. If you're a patient investor and you're taking a look at some of these charts, you go, look at the upside on these companies when they break out. It's huge. I thought it would have started this past summer. Apparently it'll be next year. But I think it's still coming. Timelines are tough, right? Sometimes you have to suck it up and wait. Now here's another put decision you have to make. Do you already own some Centennial? A lot of us own some Leaps. So we probably want to sell the 1750s and take a little less cash, right? Others don't own Leaps and don't own shares. So maybe you sell the 20s. And again, make sure that you're asking for the ask, set a good till cancel, and in a day or two, the volatility will usually hit you. If it starts to move away from you, then you, after a day or two, you adjust it down, right? Pretty easy. Continental Resources. He doesn't like to hedge his oil, so I think that you're going to get a pretty good rally with this one. It has gotten the crap beat out of it. I'll show some of these charts. Who else we got here? Antero. Oh, and then just XOP. All right. Right. None of them have done good in the last year. They rose, and they all got in the last 3 months. They were at 70 something, down to 49. They are at what's your chart? The XOP was at 44, down to 36. Right? They've all gotten beat up, especially in the last month. This is a great opportunity to sell these puts. And again, you have to decide which put you want. So with Continental, a little bit more expensive, so you probably need a 6-figure account to sell this one. Do I want this put to me or don't I? And you take a look at the range here. I would almost say a pretty strong argument for being able to sell the out of the money puts here. But you got volume here. So always look at the volume numbers. If there's no volume, you might not get a sale. If there is volume, that's where you can usually get a little, get an extra nickel or dime. And Kana, my favorite, still my favorite after the merger. And Kana is going to sell their Bakken assets, maybe to Continental Resources, right? Continental's big in the Bakken, and these guys want to sell that asset. I could see Encana and Continental Resources doing a deal. They've announced another $1.5 billion in buybacks or something, and they're going to continue raising their dividend. Permian, Stack Scoop, a couple of Canadian plays. They're going to sell their Bakken. They're probably going to sell their New Mexico asset. And there's one other asset that Newfield brought in. I forget what it is. But again, what do you want to sell? Honestly, I want to own this stock. I'll sell the 9. If it gets put to me, so be it. I get a net cost of 8. Right? XOP, do you want to play the whole complex? XOP, the ETF, that's insurance against being wrong on an individual company, right? So I'm about half my oil money is in XOP, half of it's in these names. Again, take a look. And honestly, I think you can sell the really expensive puts here. I think you go a couple dollars out of the money. Take the 10%. If it gets put to you for a net cost of $35.35, awesome. All right. Solar stocks, as the price of oil goes up, solar stocks will have a tailwind. On its own, First Solar is the strongest company out there, and they're going to be working with utilities. They're going to dominate that market. I think that you can sell any of these, and again, it depends on what you own already. Lower strike price if you already have a position, higher strike price if you don't. SunPower, people talk trash about this company all the time. I'm telling you, with Total owning 3/4 of the company, give or take, they're not going anywhere. So their balance sheet is pretty mediocre. But California is requiring houses to have solar on them now. And that's going to come to the rest of the country by middle of the next decade at least. I mean, maybe sooner. These guys are a leader there. So is that car company that we bought $80 ago. All right. So again, if you don't have a position, sell the 6. So slow. I don't think you need to sell all the way up to 7, but you could. $1.21. Divided by 7. 17% for the next couple of months. Right? Have a net cost of $5.79. Yeah. I'd probably sell the 6s. But I have a position in this one. So this is the time. These are the times when you want to sell. When you get these corrections, that's when you want to sell puts. All right, let me take a quick look at the questions. Anybody have questions about those? All right. I'll answer some questions here now. Read this article. All right. Government can't afford much higher rates. Correct. Bought some CTL. The Fed must beware averages. The average annual temperature in Death Valley in San Diego is 70. Okay. I just talked about oil. I'm not going to talk about the specific trade that we're putting on right now. When I'm done recording, we'll talk about that other trade. Why can't the U.S. make a deal with Iran via Russia? I'm not really sure what you mean on oil. I'm not really sure what you're asking there, Mr. Future. Yep. Is buying leaps. Okay, so everybody keeps asking me about leaps. Here's the thing with leaps. They give you leverage, right? But they make your risk go up. So you have to be really careful when you buy leaps. And I have learned now that I've got 400 or 500 subscribers, and walking through this over and over again, is people get too happy with their leaps. My entire strain this year is because the leaps haven't worked out yet. And the reason why I haven't really gotten my butt kicked is because we've made a couple of really good macro calls and got out of the way of these big corrections and even owned some hedges, right? So because I was hedging, I could afford to buy more leaps. But if leaps represent more than about 10% of your portfolio, you really are reaching out for a lot of risk, and you better know how to hedge your risk. So I wouldn't go more than about 10% of your portfolio in leaps. You can go up to 20, 25% if you really understand how to hedge your risk by using puts to prevent against elevator drops. So, I'm not a big fan of leaps at this point because I know most people are overextended. If you don't own any leaps, right, long-term calls, now is a really good time to buy the oil leaps if you're not already heavy there, right? And as these prices go up and as these companies make more money, the leverage is going to work the other way. Even though you're down 20, 30% on some of these, 40%, 50% on some of these, it comes back very fast. So you just have to wrap your head around how fast the prices can move. I mean, take a look at the Micron leaps, right, that we bought around 9 or 10. They went all the way down to 250, 260, and now they're pushing 5 again in a matter of weeks. You don't have to be so fast moving with your trigger finger. Do I consider SunPower and First Solar to be energy or tech? I don't remember. I think I started them out in tech. Let me take a look at the very short list. I have Tesla in tech, but I have moved SunPower and First Solar to energy. I don't know if it matters that much, right? Technology is everything now. Sanctions. Yeah, I don't really understand the question about Russia and Iran and the U.S. on sanctions. I don't really get it. What are you have to write that out in longhand for me. I don't understand the question. How much do you recommend to invest? I have asset allocations. Look at the very short list. Right? Read. Just somebody else's. Read. Right? Read this. I mean, honestly, if you're in the service and you haven't read this, come on. All right? We talk about all of that. Position sizing, all of it. It's all in there. Position sizing, look. It's right there. So, in any case, I mean, I guess I should probably put this into a PDF, right? Do a PowerPoint, because that way people might be more likely to read it to the end. But this has been updated, so this is what you need. Don't forget about the red and blue pill, right? Politics, red and blue pills. All right. What are your thoughts on TERP? I'd rather own Brookfield, right? So Brookfield owns that now, or big share of it. So one of the companies on our list, right? We have a company on our list that would encompass that. Now, let me talk about how I screen for stocks. I just start with the magic formula and a couple of other things, and I modify different screens, and I see which screens agree with, when a stock pops up on 2 or 3 or 4 different screens, it catches my eye. Most of the stocks that we're really following, and there's 40 on the growth list and 60 on the dividends, 100 stocks in our narrow galaxy. But then you have to throw in the Dow Jones. And then we have a dozen international stocks, and that's certainly going to go up. And then we have the alternative income plays, and I haven't even finished that yet. But there's, 20 REITs, and, so we have a universe approaching 200 companies that we're following. And I think I'm going to come down to Texas in January if I can break away, and if I'm not snowed in, because I think I'd actually drive, because there happens to be a poker tournament on the way in Oklahoma, North Dallas. So maybe I'll come down to Texas. All right, let me turn off the recording here, and we'll answer some of these more specific stock-specific questions.